Hey, good morning traders and investors. Bennett with tradinganalysis.com. Welcome back to our weekly Wednesday live stream show. Hope you guys are doing well today. Thank you for taking time out of your Wednesday mornings to join us. Halfway through the month of June, the Fed decision is upon us. Will the Fed stick with the originally planned 50 basis point move, or will last Friday's hotter than expected CPI data for the month of May lead them to move 75 basis points? It's really rather interesting if you look at CME Group's countdown to the Fed, the repricing of the probability of a 75 basis point hike for today. moving from, I think it was 1.8% chance last week to now a 97.9% chance. Markets very quickly priced that in. We're going to take a look at the charts, take a look at the wave counts in just a few minutes. The bearish flat count has been confirmed, in my opinion. We'll get to that in just a few minutes. Before we do so, we're going to bring in the trading analysis team, see how things have been going over there. Good morning, Terry. Good morning, Alex. How are you doing?
It's hot here in Texas, Bennett.
It's very hot, like triple digits for a week, 106 over the weekend. My goodness.
Yeah, I think here in Southeast Texas, we're supposed to see 101 this weekend, and with the high humidity, that's just insane. I'm telling you.
That's
I
right.
ain't planning on being out much.
I was going to say, Alex, do you guys get a lot of heat and humidity over in your neck of the woods?
Less humidity, but heat is present as well as in crypto. So heat everywhere.
I love it. I love it. Speaking of cryptos, big move to the downside there in Bitcoin. We are coming into focus with the fourth wave support zone that Alex he's been on top of, forecasted that April of last year. So excellent work there, sir. We're going to see if that holds. If you guys, of course, are interested in crypto-specific coverage, check us out, tradinganalysis.com, and, of course, Crypto Lab tomorrow morning, 9 a.m. Eastern, right here on this Trading Analysis YouTube channel. So what do you think, Alex? You think this is the washout move into the fourth wave support?
Well, there is a strong support, many evidence. So if this zone doesn't hold, of course, the basing process might take some time. But if we break this, I will tolerate 1,000 or two on the downside, because weekly 200 moving average, apart from other supports we have there, has a bit of a broke habit in the history. We can tolerate that, but below 70K, I will start to be relatively worried for that outcome.
Yep. I completely agree with you. If we get below those December 2017 highs, things could get interesting. So, hey, we're going to take you through the charts. Terry, Alex, anything specific that you would like me to cover? I'm going to take them through the S&P. We'll take a look at the NASDAQ, Russell 2000 small caps I see a request for. If there are any specific sectors, Terry, that you'd like me to cover, please let me know.
No, pretty much it's everybody's waiting to see what the Fed decision is going to do. Sector rotation. Sectors aren't really rotating. We'll talk about that here in a moment. I mean, they're waiting on a major shift. Broad market decline, pretty much everything is still where it's at. So nothing stands out to me just yet.
All right, sounds good. Gentlemen, I'll be back on the other side. I'm going to take them through the charts, and then we will carry on into sector focus. Catch you in just a couple of minutes. All right, good morning once again, and thank you guys for tuning in. Taking a look really quickly at CME Group's countdown to the Fed, we can see going into today's Fed decision, we have a 97.9% chance that the Fed does move 75 basis points, and now only a 2.1% chance of a 50 basis point move. You can see here in the bottom of your screen how these probabilities have shifted following last Friday's CPI print. All right, so let's hit it. We're going to hit the hard right edge of the MotiveWave platform. Take a look at price action in the S&P 500. We met over the past couple of weeks. We have been discussing and kind of debating whether or not we have the evidence to suggest a three-wave decline completing into the May 20th low, with a fairly clear market decision on the horizon. We have been a bit cautious, and we've been awaiting confirmation of trend before any further positioning. So what we have here is just a simple scratch pad count of the S&P 500, and we're going all the way back to the January 4th high. And from the January 4th high, I continue to see this as a five-wave decline into the February 24th low. It's a bit of a strange five-wave move, and as a result is a bit subjective in that one could technically entertain the initial corrective decline as completing January 24th, which would basically make January through the March area highs all of some sort of a B or X wave. From the late March area high, we were considering the possibility that we had up in 1, down in 2. This was up in 3, in that you'll see we met a near 1618 projection of the initial Feb 24th through March 3rd rally. With that in mind, going into April, we set up a bit of a decision zone. And what occurred following the March high was a 5-wave decline into April 12th that violated the impulsive possibility on the upside, which means this can no longer be up in 1, down in 2, up in 3, down in 4. Technically, it could have been some sort of an expanding variety diagonal. Those are a bit rare, and you don't typically see them coming out of this kind of a correction. So what occurred is 5 waves down to invalidate the impulsive trend, 3 waves back, and then the break back under 44.16 in the S&P essentially confirmed the move down to the equality projection of C compared to A, and that came in at 39.59.82. Okay, you'll notice when we met that equality projection, we were also meeting corrective channel support. And the corrective channel support is very simple. You take the high or the origin of the overall corrective move, you draw your trend line through the high of the B wave, and then you project your parallel trend line over the low of the A wave. And in this case, the low of the A wave came in February 24th. With the equality price projection at 39.59 and channel support, you can see markets attempted to put up a fight. We did break just under equality, we broke under the corrective channel, and then what occurred from May 20th up and through June 2nd, maybe June 7th, we have a 5-wave rally. Okay, so we knew at that point that it was possible this was a completed ABC corrective pullback. This set up another decision zone, very similar to what we had back in April. What we advised is that we await confirmation that this 5-wave move actually is upside resumption in maybe A of X or wave 1 of some sort of a higher degree continuation. That 5-wave rally has since broke south with now 2 acceleration gaps. The 2 acceleration gaps have now moved south of impulsive invalidation, which was at 38.10. So I view this as confirmation that markets have opened the door to 3,600 in the S&P 500. This, in my opinion, suggests that the very unusual ending diagonal count, which was the only valid MotiveWave count that we could arrive at for wave C, that this was not in fact the case, but we actually had the wave 2 fractal unfold, which allow me to adjust scale really quickly. The fractal was of the higher degree corrective wave. So I view price action, and we talked about this 3 or 4 weeks back, I view price action here from May 12th through June 2nd as a fractal of the higher degree corrective wave, which means this is a flat and we are now moving lower in what should be a 3rd wave position. This means that from the March high, the 5-wave decline completed May 12th. We have 3 up to the 17th. We had 3 back down into the May 20th low. We met support at about the 1272, and then we rallied up to the C versus B 1272. Said otherwise, it's an external retracement of the B wave. And that 1272 resistance at 4170 happened to line up with what was previous support, now turning resistance. This tells me that we have at least wave A down, wave B back, and we now have 1, 2, and we're breaking lower in wave 3 of at least wave C, and this could actually materialize into a 1, 2, 1, 2 progression. I'm not going that far. I don't think that a 1, 2, 1, 2 count fits well the higher degree 4th wave that we have as a possibility. So I personally am going to continue to respect the idea that this is still just a wave 2 pullback of the rally from the COVID low. This allows simply for a deeper, more drawn out retracement. So getting you off of the daily back down to the 195, the characteristics, the nature and way in which price action rejected the 1272 and rolled over last week is very indicative of a wave 3 position. You have multiple acceleration gaps, you have a new most significant angle of descent compared to anything else that we have seen from the January 4th high. And this should now take us down to our 1618 target. And our 1618 target is simply a projection of the January through February 24th decline. You'll notice that C versus A 1618 at 35.91.59 essentially takes us back to what was resistance on September 2nd of 2020. Resistance on September 2nd of 2020 came in at 35.88. So we have that previous resistance. We have our C versus A 1618. And this is where I expect markets to progress from here. Getting you off the daily back down to the 195, we have a very vertical decline here from the C of wave 2 completion. I see on the charts enough evidence of technical divergence. There are some internals that we reviewed with our clients last night that supported the possibility of a rally back in a wave 2. What this means to me as a trader is, number one, downside to 3,600 is open. So layering in shorts with that objective in mind would be appropriate, but one would need to do so knowing that a corrective rally in the form of a wave 2 is likely on the horizon. At this point, I view any three-wave rally as a short opportunity for a move down to 35.91 spot 59. Now, what happens if we meet the 1618 and we don't stop? In the event we meet the 1618 at 35.91.59 and we don't stop, I will allow for wave C to meet a 200% relationship to wave A. That would take us back to the pre-COVID high, which occurred in February of 2020. So this gives us kind of a zone between 33.93 and 35.88 that we would need to see the S&P respond to. Now, what happens if we continue beyond the 200%? Or let's say what happens if when we meet that, we then enter another correction. If we meet the downside objective and then enter another correction, that's when we're going to have to consider the more bearish possibility that this is 1-2 instead of blue A and blue B, and this is going to be 3-4 and we go down in 5. For now, I'm going to continue to view this as wave 2 of the higher degree wave 5 ending diagonal, given the fact I only see 2 actionary waves from the COVID low. So that's the S&P 500. Taking you from the S&P, and actually before we move on from the S&P, I saw a comment regarding the possibility, and I actually received multiple emails regarding this possibility, and the question was this: could in fact this just be a string of Elliott corrections or a complex, which would suggest in fact that we have 3 down into February? So this would be ABCW, ABCX, and this would be A. The flat that we talked about would be B, and we're now moving lower in C. Here's my take on this possible wave count. Generally speaking, our wave Y and W relationship is closer to equality more often than not. And even the times we see Y and W, the Y and W relationship meet a 1618 down here at 35.91, even in that case, would you expect to see the most vertical angle of descent with 2 clear acceleration gaps in what is supposed to be C of wave Y? I don't think so. I don't think this is typical of what you would see in C of wave Y. So much so that while I acknowledge it as a possibility, I just can't wrap my head around this, this particular wave count. The way markets responded last Thursday and then into Friday is very typical of what one would expect if this were wave 1 and wave 2, and we're now moving lower in a third wave position. So that's my take on markets. I'm going to continue to look lower. I do think 3,600 is on the horizon. If we don't hold 36 area, the 1618, we can move down to 34. In the meantime, although wave 3 positions are often very vertical to the upside or downside, and they often lack clearly discernible 3-wave corrective structures, it's possible that we just continue to move lower in wave 3, but I do think there's evidence to suggest we at least get some sort of a corrective bounce. So watch for any sort of corrective bounces. We're going to be doing that with our clients at Trading Analysis. and looking to maximize opportunity into what should be wave 3 of 3, in my opinion. So that's the S&P 500. Over to the NASDAQ 100. Here in the NASDAQ 100, I see the exact same wave count. I see a big flat correction starting May 12th. We have a B versus A, 1272. We've got a C versus B, 1272. And that shut down markets for a very sizable, swift move lower. Same thing here. We're looking lower. We're targeting now a move down to 10,000 as a possibility. I'd watch the swing point low from September of 20 on the move down, but a very, very sharp rejection of that flat. And in the case of the NASDAQ, if you take a look at our cycle degree trend channel, we essentially, after breaking under the upper boundaries of that cycle degree trend channel, we back tested it. And that was we had a confluence of resistance there that helped start this move lower. And of course, take into consideration last week's CPI print. So that's the NASDAQ, that's the S&P. Over to the Russell 2000. I'm glad you brought this chart up because last week before markets rolled over, I picked up on 2 specific charts with our clients that would suggest the flat count, the bearish count in the S&P and the NASDAQ was the operative wave count. And what I noticed specifically about the chart of Russell 2000 small caps is this. From the low, in this case May 12th, we actually have 5 up and 3 back into the 20th. We do not make a new low on the 20th. And then we rally in 5 waves to just beyond equality of C and A. We met our 50% retracement in about 61% of the duration of wave A, or wave 1 to the downside. The reason this was unique is this. In the S&P and the NASDAQ, we had 5 waves up. And in the case of Russell 2000 small caps, if May 12th was the end of a correction, we only had up in 1, down in 2, up in 3, which means small caps would have needed to do down in 4 and up in 5, while S&P and NASDAQ were doing ABC in a wave 2. So that was a bit strange, I thought. And I do think we are now on our way south. Let me back out here to the daily chart. Let me go daily. Apologize for the clutter here. We're going to need to look to 1647 as our first objective. Next objective would be 1402 spot 37. A lot of this is going to depend on structure. And then the other chart, which really stood out to me and was starting to signal, in my opinion, that the bearish flat count was the operative wave count, is the chart of the SMH, the semiconductor ETF that we all love to track. And very similar to the Russell 2000 small cap index, it made its low May 12th. It had a pullback on the 20th and then a secondary move up. So we had only done 3 waves up while the S&P and the NASDAQ had done 5 waves up. Hard to expect SMH to do 4 and 5 while the NDX and the SPX are doing ABC in a wave 2. So that was favoring the idea that we have been in a corrective ABC rally and markets have lower to go. So that's my view. Again, if you're interested in more day-to-day coverage, our Elliott Wave work in the markets, please check us out anytime, tradinganalysis.com. That's it for me. Back over to the team. What do you guys think? Any thoughts? Uh-oh. We don't have audio. We've lost Terry. Oh, there you are.
I'm sorry. Hard to
No worries.
argue with that data analysis. Good job, Bennett.
Yeah, that rejection of that flat and the fractal relationship to the higher degree corrective wave, it's interesting. It's interesting. Very typical, in my opinion, at least, of what a third wave should look like. But again, we're in a very unique market right now. So while I'm discounting that WXY idea, where we're in C of Y, this market has many variables that could ignite that wave count, which is why I think it's important to be aware of these and track them one wave at a time. So that's it. Hope you guys enjoyed the content. Mr. Terry Long, sir, I got your screen up ready to go. You're going to take us through some Optima, take a look at sector rotation, talk about the lack of rotation that we are seeing. It's a crazy market. It's a crazy market. Just checking the questions. All right. I think we're good to go. You ready to rock, Terry?
Let's go.
All right. Take it away. We'll be back on the other side. Off to Mr. Terry Long in Optima.
Hello, traders and investors. I'm Terry Long at tradinganalysis.com with your weekly sector focus. So last week, the latest CPI reports on inflation were released. Volatility heated up again and pushed the markets lower from their recent period of a 7-day consolidation. We seem to have rolled right off the cliff there. Last week, all major indices moved sharply to the downside on Thursday and Friday. Today, the eyes are on the Fed, watching to see if they stick with their original plans with a 50 basis point hike, or do they bend to the media pressure and raise the rates by 75 basis points. Now, while the first half of the week here, Monday, Tuesday, and Wednesday, remained mostly range-bound within the prior week's trading range, Thursday and Friday's significant moves pushed the market lower and set up the opportunity for this week's Monday and Tuesday push that then took out the May lows in both of the indexes. Last week, the S&P ended the week down 5%. It's kind of hard to see. It's buried back here. 5.05%. And the NDX declined 5.7%. If you look over here on the left, this is the 11 sectors that fell last week. Energy last week was the least affected sector, only down about 0.89%. Last week, the hardest hit was the financial sector, followed by technology and real estate, all of those down more than 6% each. Let's take a look at what's happening here today. Like I said, pre-market moves, Monday and Tuesday's price action, both gapped lower. You can see the gap. That was one of the things I was going to mention. Bennett said typical in the third waves are these gap. Of course, I'm plotting the cash session dailies here, right? So there's overnight and pre-market moves that happen in between, and that's how you get these, end up with these gaps when you look at these cash sessions. But that's typical. That's a very aggressive, impulsive move to the downside, typically what we see in wave threes. All right, so all 11 sectors over these past 2 days are lower, but curiously, it's the utilities sector. I got a table. I'm going to pull this table over. You can see the numbers if you're looking at this utility sector right here is down 6.43% in the past 2 days. It was down 7% before pre-market trading opened up a little bit this morning, and I think we're starting to get some adjustments on some of these numbers here. The worst performing sector. Now, in 2 days of trading, the best performing sectors are the industrials, the staples, and look, technology sitting up here at number 3. Yes, they're not denying the fact that it's down 2.5%, but we're talking about relative performance here relative to the benchmark. And the technology sector sitting there in number 3 position right now. It moved from 4 up to 3, it looks like, this morning since I wrote this. Okay, let's move over here to our relative strength sector leader scoreboard. And the energy sector, no surprise there, continues to see rising momentum, and it maintains the highest relative strength of all sectors. It's not immune to a rollover, though. I will caution that the very latest move there is Monday and Tuesday's price action. You can just see the tip of that starting to roll over. Again, that last vector does not complete itself until the week is over, but there's the tendency that we've seen the shift there. You can also, as I'm animating this, look over here and you can see the utility sector making a dramatic push to the southwest. Again, that's because it's starting off the week 7% down. That's nearly double what the S&P is down. So again, these vectors are relative to the S&P performance. Now, the real estate sector has gone ahead and pushed down into the weakening quadrant as we predicted, and it looks to continue that. Matter of fact, it actually looks like it's accelerating to the southwest. We're also seeing a negative tilt here in healthcare, maybe a little bit in staples. Material sector seems to be the most resilient of all right now, and actually The industrial sector, which I've been touting for the last several weeks as being fairly neutral and similar to the S&P because of its close proximity here to the origin, look at the move I'm seeing in the industrials. And again, that's because I told you the industrial sector was, let's go ahead and sort this again. The industrial sector is technically outperforming the S&P, and it's the top performing sector. So in the face of a broader market decline, or like I said, you really don't get a lot of change in the leadership, more so just a continuation of what they've already been doing. But a little bit of interesting things there happening in industrials. We'll go ahead and take a look down here in the lagging quadrant, and again, we've been seeing this is. I'll take you back to Friday. That's last Friday's vectors. We've got rising momentum in financials, but again, from a relative strength perspective, financials, technology, and consumer discretionary are all been underperforming the S&P. Fast forward to add in Monday and Tuesday's price action, I'm now getting a northeasterly tick here back in the technology sector. A little bit of a momentum shift there in discretionary, not much change in communication. So really hesitant there, I think, to make any serious advances. It remains momentum neutral, right? So there's really not, the vectors are very tiny, momentum neutral, relative strength neutral. We really haven't seen any big shift out of that. Well, that's it for me. With a broad-based market decline, like I said, we really haven't seen any significant shift in the sector leadership at this point. I do believe that once the market finds its bottom, we'll start to see more significant changes in the relative performance of each sector. And that's going to give us a clue where to start to look for the next set of market leadership. Back to you, Bennett.
Very good, Terry. Much appreciated. Certainly quiet on the rotation front as markets have been in this period of distribution and correction. As Terry mentioned, however, once markets start to kind of focus in on and hone in on the completion of the current corrective pattern, rotation overall is going to be a very key topic, gauging kind of sentiment of markets coming out of the correction and sector leadership. So we'll continue to keep you guys updated there. We've got Alex coming up in just a minute. I believe he passed the presenter mode your direction, sir. Alex is going to take you through the macro scene, maybe a hint of Bitcoin to bring you over tomorrow morning for Crypto Lab, where he will have more in-depth coverage. Any luck grabbing the screen, Alex? There it is. Nice. He's ready to rock. Just let me know when you're ready to go, and we'll get going. I see a couple of questions. Tesla, I continue to look lower in Tesla overall. I do think Tesla could be in a larger fourth wave, but I do think it's going to push lower with markets down towards 550 area support that I think we reviewed previously. So we'll touch on that perhaps next week after the Fed decision. All right, Alex, you ready to go, boss?
Yes, let's go.
All right, take it away. We'll be back on the other side to wrap up. Markets open in 6 minutes.
Hey guys, let's do a quick macro overview. As you know, we are tracking this 10-year yields. We have labeled this in the last couple of weeks as a wave 4, and we are getting now the response on the upside in this wave 5. We looked possibly rates to top in this cycle on the upside from 3.3 to 3.6, so there is a big resistance levels from the previous peaks. So this is the 40-year chart, and we noticed that the RSI, of course, is also very high. We have a bit of divergence currently, which is usually in the Elliott wave sequence. You can notice between the wave 3 and wave 5, which exactly is happening here. So this is a weekly level. This is most, I will say, applicable on a daily and weekly level. So we might pop up a little bit. Today's on a Fed, but we do expect at least some type of a pullback or a consolidation after this proposed 5 waves on the upside. On the other hand, European Union or the ECB has announced a move, a little bit of a move in September in regards of the how they're going to change their monetary stance. We are seeing the third wave expansion, which I think it's the wave 3 of 3. So this is definitely a bullish outlook. We will get very soon, I think, in a wave 4, 5 and larger 3, 4. So usually we call this overall range sideways for a couple of weeks or a month or two after we might get a final push up in this fifth wave. So this is going also according to the script. We are trading above the very long channel, almost 40 years, which is a sign that we now have possibly fully 5-wave move from lows in developing, which will mean that after a possible pullback somewhere down the road, we'll have potentially a little bit more upside. Depends how this pullback actually resolves. So potentially the inflationary pressures or the rates moving on the upside might stay a little bit longer, at least in some measure than market anticipates. If we move to dollar index is also moving according to the proposed script. We label this as a intermediary wave 4. I like to push this wave 4 a little bit more in line with this rates outlook. So I would rather have it a little bit more on the downside after this high. So we can count 1, 2 up in 3, down in 4, up in 5. So this will be an intermediary subdivision in 5 waves, which gives us a space for a pullback and another push towards this 107 handle, most likely before we see some sizable, at least 3-wave pullback correction in the dollar index. So this might get a little bit more extreme if we count standard measures, but I will not go down to that path, because that will be something of a dollar moving sharply on the upside in a 111, 112 zone, which will be pretty detrimental either for US exports or also for the emerging markets debts, which are denominated in US, and there is lots of that stuff out there. So I would like to kind of call a more modest rise in dollar before we see some type of a correcting pullback. If we switch to a commodity spectrum, Thomson Reuters index, which we track for this 5-wave move, we have enough of substance to actually conclude this wave 5 here. I will leave it a little bit more open if we get another push higher, but I think we are very close, as we were proposing this last couple of weeks, for some type of a couple of months of consolidation in some type of a B wave or a second wave. So we have a full 5-wave sequence now. We might get a little bit more upside, but in this range, the possible ending of this move on the upside from this COVID low might be very soon, as I see the sequence developing. So as on the other charts, I do see, as I announced a couple of weeks before, a certain pause in front of us, at least in a form of a sideways consolidation. If we look oil is still range about, trading between this 95 to 120 range. We do have proposed a possible triangle here. Oil is among one of the commodities which are still pretty much holding well into this range. This is some type of a triangulation, or this is some type of a B wave, and we are now going to have C, D, and E, so more consolidation in front. We cannot know in this moment, or we're going to actually penetrate the upside levels. As long as we stay in this type of consolidation between this range, which is actually giving the same support as the previously support zone. In this case, we penetrated this zone on the upside, so the same case can happen here on the upside towards this third wave high. So this is left to be seen. The conclusion is that oil is staying within proposed range that we are tracking for the last couple of weeks. and we don't have any reason to believe yet that oil will go and break this 95, 97 levels, at least not yet. More likely, looking this consolidation, oil has a more probability to break on the upside than on the downside, as it looks for now. Our net gas chart is working quite nicely. We have seen a nice push down from our fib zone, so we are looking for the wave 3 completion. That's a little bit of seasonality as well, although the geopolitically price of gas, as you know, is moving on the upside. So we do expect some type of a consolidation in the summer season. Of course, the less gas consumption is going to be present in the market, so that's just a simple seasonality thing. But then from September, October, when the winter kicks in, or late autumn, December, winter, we do expect to see a further development on the upside in gas prices, because the 5-wave sequence is still not done. We are seeing a very nice subdivision in the intermediary wave 5, if we take this one as a primary. So we can clearly count 5 waves on the upside meeting this fib zone. We possibly started a pullback in some form or the other. Wave 4 can develop in numerous waves. One of the possible is also a triangle, which will mean that we're going to have some sideways consolidation price action, something similar to oil, or we can have something more exuberant to the downside in WXY. We cannot know this in the beginning stage if we look through the Elliott wave lens, so we need a little bit more data. But anyhow, the conclusion is that this fib zone that we proposed is currently acting well. And as long as we stay below this zone and start developing some wave pattern, we will label it as a wave 4, which is also, as I said, agreed seasonally with this development. So this couple of charts are working well for now. If we switch to gold and silver, not much of a development there. So the bullish gold chart stays the same. As you can see, gold didn't really give us anything substantial on the upside. It is still possible. Definitely we will see some reaction on the Fed meetings in the gold market. We are very close to invalidate this wave 2 here, a little bit more downside, and then we will have most likely a fully developed sequence to the downside, which will give us a more bias to the downside in gold after some type of a pullback, than actually to stick to these bullish developments. Why? Because we didn't actually see any confirming price action, which will mean that we will see a clear 5 waves post these lows, challenging the previous swing high, which will give us enough of probability features that we can actually put a small wave 2 and developments in a wave 3. So most likely we are going to switch, if we break these lows, to some type of a complex correction down to this 1,672, or if you label this as a WXY, you will have a different wave structure. Actually, you will have it like this. If you want to have an ABC, you will have a flat, and WXY will give you an ABC for a Y wave here. But the context in this case is much more important than the shorter term wave count, since the target is basically the same. So same situation in the silver. Silver didn't manage also to give us anything substantial on the upside. We are still seeing a hesitation and a sideways price action between this 400 and more days support and 200 moving average on weekly. So we are now at that zone. I do think we will have one more push lower just to confuse the markets. So this also can be labeled differently, but it's not the question how you're going to label this. The context is that even with a small pullback on the upside or some type of a consolidation, you will have a lower levels reached, which ranges from, let's say, 18 to 19, looking this 50% retracement, which comes at 1871. So we are still tracking this consolidation, which took so much time already, I think 2 years or something like that. So let's see from where this actually started, if we count this. So this is actually February 2020. If we take this as a wave 5, it's January 2021. So we are looking for 1.5 years of this tough consolidation in silver. So Bitcoin, let's mention this as an intro for the tomorrow's crypto lab. So as you know, we have been looking for these targets in Bitcoin for a long time. We proposed at March 2021 only 2 possible wave counts. There were many more, but we focused only on 2. It was a triangle or a complex correction. So triangle fell off, of course, when we broke these levels around 30K. So we are focused now to our target, which comes with a plethora of support levels between 20 and 23K, and we are already there on many of the cryptos. RSI also on this weekly level are touching the pretty interesting zones. As you can see in previous lows, this 200 moving average was penetrated a little bit and then actually continue on the upside. So we are awaiting possible confirming price action or whatever market has in store in us, but we finally reached our levels, which we have been waiting in the trading analysis for a long time to be reached, and we are focusing now how we should behave in this market situation and what our positioning should be longer term. So if you want to hear more about that, join me tomorrow for the Crypto Lab, and of course I will go over a couple of other cryptos which has really nice setups with a very small risk that we look at trading analysis. We reached on many cryptos our preferred lower targets, and we are starting to look for a possible small confirmations, possible positions. So it starts to be a very demanding and interesting from the perspective of how should you behave in this environment and what actually the price chart is telling to you. So we're going to talk a lot about the sentiment as well. So back to you, Ben.
Very good. Much appreciated, Alex, Terry. Excellent work, gentlemen. Bitcoin, my goodness, what a move down. I love the 4th wave zone coming into focus there. Curious to see if we hold. And as we talked about recently at one of our crypto webinars, if you had the opportunity to attend, is the very favorable and attractive opportunity that zone will present. So check us out, tradinganalysis.com, if you're interested in staying up to date with Alex on the crypto side. And of course, join him tomorrow morning, 9 a.m. Eastern, right here on the TA YouTube channel for Crypto Lab. All right, markets are open. S&P ticked to the upside, a little bit of a gap following the move in the futures market. We are going to continue to watch for that ABC retracement possibility. Does it come as a result of today's Fed decision? Only time will tell. Members, we'll see you in about 21 minutes for our weekly member webinar. Viewers, appreciate you all tuning in. If you did enjoy the content, please subscribe with notifications, give it a thumbs up, and we'll be back same time, same place next week. Gentlemen, excellent work. Any final words of wisdom before we let them get out of here and enjoy the rest of their day?
Well, let's see what the Fed has for us today.
Let's see what they've got up their sleeves, huh? Jay Powell,
yeah.
Will he deliver? All right, appreciate it. Terry, excellent work. And Alex, excellent work. We'll see you guys next week. Be safe, and hopefully see you tomorrow as well for Crypto Lab.
See you guys.
Take care. Have a good one.